Hey everybody, welcome to our first Saturday of every month's free Trader User Group monthly market recap. This is for a recap for the prior month, but we'll kind of just cover some of the year-to-date information that we've seen the markets undergo. Really interesting year as we go through 2015. Before we get going, however, just a couple of quick thoughts. Trading securities can involve high risk and the loss of any potential funds invested. Any investment information provided by a user group may not be appropriate for all investors, provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information techniques that we talk about by our user groups tended to be for educational purposes only. It's not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain is probably going to want you to do. So, before we get going this morning in the year-to-date performance of the markets, we're going to spend about an hour covering that. We're going to cover sector rotation. We're going to spend a little bit of time in the oil markets, a little bit of time in how we've been trading. Some of our members have been trading. Some of our more active members have been trading oil and natural gas and gasoline. And we're going to talk about where I think the markets may be taking us as we go into the summer months, or a higher probability of what may happen. We're just going to kind of cover some of the major sectors, as well as the certainly the major commodity sectors. We're going to take a look at the bond market as well. So we got a lot to cover in the next hour or so. Before I jump right in, here's a shameless promotion for our user group, though. We got a number of folks on from around the globe. If you're interested in some of the stuff we do, I highly recommend you come on in and just register. It's free. I don't want anything from you. Sign up, and then you'll get our every week I come out with a market recap, and then once a month you'll get this. But if you'd like to become a member, it is fee-based. You can come in and see a number of things that we do. By the way, some of the things I'm going to talk about in oil or in some of the other commodities, I've got a 8-hour video series on futures market. And I've got a number of other educational series also, so I highly encourage you to check that out. If you want to become a user, then come on in and join us. If you have any questions, just click on the Contact Us button, and I'll be more than happy to get back to you. Now, enough of shameless promotion, which I really hate. Let's take a look at the market relative performance year to date. You can see I've also inserted in here, which I've been really pounding on the desk for quite some time for our members, these two areas. And let me just see if I can get my color here to show this. So bear with me 1 minute here. Well, that just doesn't make sense. Let's see here. Okay, here we go. Okay, so right here we have NASDAQ, or you can see the the Qs right in this area here, which has been one of our recommended ones. MDY, or the mid cap, right here, which is another one. And then, of course, we've got the S&P, we got the Russell, and we got the Dow. Now, we've seen since April, the beginning of April, there's something interesting that's going on here. Oh, what the heck is this? Bear with me 1 minute, guys. Let me just get a couple of things here. I hate it when these things pop up on the screen, these annoying programs. So we've got MDY right here. As a lot of our members know, we've been heavily focused from January through the first quarter in IWM, the Qs, MDY, and IWM or TNA if you want a 3X small cap bull. Right here. These are the guys in the first quarter of the year that have been very strong. Very good that money was flowing into the Russell or IWM if you can't trade the futures, or TNA. They kind of go hand in hand. It's the 3X small cap bull, or the NASDAQ, the Qs, and MDY. Now, we've played all of these. Money has been flowing in through Q1. But then right at the end of Q1 going into Q2, starting in April, we've had a sudden shift and money has been coming out of the Russell. Money has accelerated into the Qs, as you can see right here with NASDAQ's year-to-date performance through the end of, right up to May 1st, this past Friday. I ran this last night after the markets ended. And you can see the MDY, which is mid-cap stocks, are still holding on fairly strong. S&P just barely above flatline. The Russell actually went below the opening price of 2015 a few days ago, as did the Dow, and then with a stronger finish on Friday, even though it was down for the week, it managed to claw back above the zero line. So the markets, the indices, the major indices right here have not really been performing that well outside of NASDAQ, and we had a strong earnings report last week on some of the key NASDAQ stocks. I'll show you in the sector rotation how that's done. All right, so the Qs has been a very good place to put money, and again, MDY, although this sector rotation shows that profits are being booked at the end of Q1, and money is getting a little bit tight, valuations are getting a little bit rich through the earnings season that we've been through right now. We've got about in the high 60s percentage-wise of companies that have beat earnings per share, and in the high 50s, maybe low 60s, but high 50s in the percentage of companies that have beaten the top line number of revenue. As I've always told our members, the top line number in revenue and then the bottom line number of earnings per share, it's very easy to manufacture good earnings per share. Stock buyback, which then increases without doing anything the yield on dividend paying stocks, and stocks can, or companies can up their dividends. And through merger and acquisition, you can engineer earnings per share. Companies have done it for years. You cannot engineer top-line revenue sales. You can't create sales where there are none. Sometimes you can do M&A, but when you do M&A and you slam the companies together, you can, again, engineer earnings per share by cutting costs, redundant costs, and things like that, but you can't just add sales revenue. So it's getting tougher and tougher. And keep in mind, earnings that we're going through now, we're almost done with them. It's pretty quick, another week or so, and then earnings are going to start winding down. Those companies that are missing are getting punished severely. Twitter is one. LinkedIn is one. LinkedIn, I think, fooled people a lot. Twitter dramatically fooled excuse me, people. And those stocks are just being punished, okay? But we're almost through with earnings, and the go-forward projections are not that good or not as good. So it's creating, you know, the higher the markets go, the higher the stock PE ratios and the valuations, and the less likely companies are going to be allocating a lot of long positions, or let's call it new long revenue or money investment into the stock market in the U.S. And I say the U.S. because we've also been investing in European equities via some wonderful ETFs. Now, they're starting to get a little bit long in the tooth, but I think through the end of this year, they may come out very good because they're just starting quantitative easing over in Europe. They've accelerated some quantitative easing in China. Japan, they've committed just past week to maintaining their quantitative easing. So I just believe that with this race to the bottom with a lot of currencies, you know, the U.S. is really the only lone holdout right now. So you can see where we are year to date here. If we look at sector performance year to date, I've got this solid bar here right at about the performance of the S&P 500. And we can see a couple of things that have really starting to take place here from the last month that I did this. You can see basically that the energy component right here, XLE, has really come up. If you guys remember, it was down in this area, and then it's just made a huge reversal up. Energy is doing very well. We've been playing energy. We got in, we got out, we took some profits. I'm going to take a look a little bit more focused on the oil energy this morning. You can see that's this is energy right here, and this is technology right here, XLK. And on XLK also was underwater, and it's come up very strong. Materials XLB was also very weak going into February and March. It's come on very strong. Cyclicals XLY. We like to see cyclicals up there. It's a harbinger of consumer spending. That is a good thing. And then, of course, XLV, right here, healthcare has been very strong, although it's pulled back about 2 or 3 percentage points from our last look. So money has come out of healthcare a little bit. I'll show you the rotation chart, and you can see there's profits being booked here. Now, of concern to me, industrials is still flatline right there. It's almost 0%. Okay. The other concern to me is financials right here. I do believe that with interest rates starting to move up, financials, you're going to see some money going in there. They need that net interest margin, that spread that you get with increased interest rates. So I think you're going to see that. We've had a huge couple of days of down move in the bond market. We'll look at that in the chart in a minute. I'll try and explain some of the reasons behind it. And then, of course, utilities. Just extremely, when interest rates go up, that's very bearish utilities. Okay, so we've had some good movement in the discretionary and healthcare, but I liked materials. Remember, we talked about that. For our members, I've been saying that that XLB has been doing fairly well. We played XLE, nice play here. The energy market, and then of course technology has come along very well. So from a normalized market standpoint, we've got to get this guy right here moving up. We've got to get the financial market to participate in this recovery. If it does not, it's going to keep a lid on the markets. But that would mean higher interest rates, and then that in turn is going to drive some of these guys down just a little bit. Okay, and you're going to see some shifting here, I believe, in discretionary, possibly energy and healthcare over this next coming quarter. So this is where we are year to date through Friday's close, May 1st. If we look at some of the sector rotation here, and let me just explain the chart for a number of the folks that are on that hadn't seen this chart before. It's a really good way to look at how money flows. We've got 4 quadrants right here, okay, right here. And I probably should have numbered them a little bit differently. In fact, let me do this. I'm gonna number these quadrants as far as I believe of importance. This quadrant right here is the leading quadrant, meaning everything is relative to the SPX, which is in the crosshairs here. Anything outperforming the SPX is generally going to be in the leading quadrant. The improving quadrant right here is number 2, meaning it is improving relatively to the SPX over the past time frame. In this case, we're going back almost 1 full quarter of 90 days. Number 3 right here are formerly generally leading sectors where money is flowing out of, and then of course here, this is the most lagging sector right here. So, and the way it's organized this way, it's been done, this charting thing, package has been organized this way so that sector rotation goes counterclockwise. And I've plotted this chart with 10 individual components on it. Each one of these represents a point in time relative to the SPX, okay? And you can see over 10 plots how this particular sector has moved relative to the SPX. Thus, you get this color movement here, and the color shows you where that particular sector is at this point in time. So if it's blue, it's in the improving sector. If it's green, like XLY, the consumer discretionary, it's in the leading sector. If it's red, it's in the lagging sector like XLU. And you can see here the weakening sector, XLV, just slightly below the midline there. So it's really interesting when you start making your bets and your plays. And right now, for options traders that are trying to trade a 3 or a 4 week position trade, or a longer swing trade, or a position trade where you're trying to trade an option expiration cycle, it can be a little bit choppy. The markets seem to be flipping over every week or two. One week we got a bull, and then the next week we got a bear. And then it ends up net going nowhere, give or take a couple of points up or down. But these sector charts show you, in this case, this is a 3-month chart, where the markets are relative to the SPX. Now, why is it important relative to the SPX? All big money is constantly reallocating their portfolios, primarily at the end of the quarter. So we got some quarter reallocation at the end of April into, at the end of March into April. And you can see right at the end of Q1, as I said, mid-cap and small-cap money started coming out of that and going into a little bit of a safety factor because they made some good money. And you can see this rotation here. So now what we'll do is we'll go look at this same S&P sector rotation, but let's go look at it for the past 2 weeks and see how it's done over these past 2 weeks. And so we're kind of zooming in. It's kind of like the difference between looking at a weekly chart and going into a daily chart. So if we look at this, you can see over the past 2 weeks, energy has really pulled back dramatically. And you saw on the 90-day chart, energy was up in the improving sector, but money has kind of flown out of energy. We're kind of reaching a boiling point in the oil markets. Technology has moved very strong. Materials has moved very strong, but look at this. A lot of the sectors over the past 2 weeks are lagging. Healthcare, lagging. Staples, lagging. Finance, lagging. Industrials, lagging. Consumer discretionary, lagging. You can see XLU, utilities, in an improving sector. That tells you that money is coming out and a little bit nervous as we're getting about 3/4 of the way through the earnings season. One thing I did put up here is the transportation sector relative to all these other sectors. And you can see it was lagging, and now it's immediately over the past 2 weeks had a pretty good little comeback. Over the past 90 days, it's still lagging. But the past 2 weeks, money's come into transportation a little bit. I think as energy and oil gets a little bit more expensive, it's going to keep a little bit of a downward push on the transportation sector. But technology and materials have done very well. So, but like I said, we need to see some of these guys right here that are lagging start to improve. And we want to see Staples. If Staples starts to get stronger relative to everybody else, again, that would signify more risk coming out of the marketplace. Okay. Let's see. Blake says, based on the earnings on LinkedIn and Twitter alone, won't XLK be weakening? Google also missed. Yeah, you can see, and we had several strong earnings coming out of technology, and just alone, Twitter is not a very big factor in technology. LinkedIn, while bigger, is not as big of a component. Apple tends to be the biggest component right now of these sectors, and Apple is now part of the Dow. but Apple has been getting weak over the past week. I think it's going to get a little bit weaker. But yeah, because, and the other thing, and Blake brings up an interesting point, once a stock gets up into this area or a sector, it doesn't really matter because money rotates. You can just see the flow of how these things move relative to the SPX. The next place for XLK to go is down, because big money is rotating in and out. It doesn't do it on a daily basis, but over a period of time, money moves. And what we try and do is follow the money. Doesn't really matter why. We just want to make money, and we want to follow where the money goes. Commodities over the past 3 months, you can see here, gasoline. Well, we're coming into the seasonal period of gasoline, summertime, springtime, summer here in North America. So you can see gas futures leading dramatically. Oil up over the past 90 days. So these two in the energy market doing very well. Natural gas, a cooler than normal start to the summer months has put strength in nat gas. Okay, lean hogs, you can see here also very strong. Copper has coming up over the past 90 days. Cotton is starting to probably reach a peak, but then you can see the ag market with wheat, corn, right, coming down, soybeans coming down. And we can also see gold moving down just a little bit here. And then in the softs, we got sugar and coffee. Coffee, I think, still has some more downside action to go. If we zoom in on the commodities over the past 2 weeks, you'll probably see some of these same ones that were strong are a little bit weaker now. Money coming out of them. Remember, you saw it in the energy market. We saw it in oil. Well, we're also seeing it here in the commodity market. Gasoline dropping down, oil coming down, lean hogs getting a little bit stronger. Natural gas had a pretty good little move over the past couple of weeks. Wheat, corn, again, very weak. Soybeans, we're looking at, by the way, I'm looking at trying to find an entry long in the ag market. We're not ready just yet, but I do believe it's going to be ready to go. Cotton is getting weaker, sugar weak, gold and silver are lagging the SPX. We've had a little bit of a pullback in both gold and silver. Most of you guys know, especially our members, I'm playing silver over a 2 or 3 year period. It's low. Way to play silver, we'll look at the charts, SLV, if you don't want to get into the futures market. Silver's low. It could go lower, but unlike a stock, it's not going to go to zero. And I do believe when inflation catches wind, which I think is going to take longer than most people think, which is why interest rates have stayed relatively low for a longer period of time here in the U.S., partly due to money from Japan and Europe as well. We'll look at the charts in a minute. But we're playing silver longer term, so if it goes a little bit lower, I've been selling puts underneath SLV, and I'm just collecting premium and just adjusting my trades, and then I'll probably start adding position over the next year or two, so that as it's moving up, I think 2 or 3 years from now, it'll be a nice little play. And on a relative basis, it doesn't have to move that far. We're in the mid-teens right now, and it moves up to about 24, 25. That's a pretty good return over a couple of year period for just a small allocation in your portfolio. So this is a commodity market. Let's take a look at the countries and relative performance of various countries. Now, this is over the past 90 days. Russia, on a relative basis, it was down around 14 or 15. On a relative basis, this just had a big bounce up. You can see money is slowly, profits are being taken in Russia. It's probably going to come down like that and just keep its descent here. Brazil, Latin America, coming back up a little bit. They were at the bottom of the heap. Emerging markets, Spain. But we like, and of course China, there's a big bubble in China right now. I think it's going to pop. FXI is how we play it. You got to be careful because in any bubblicious market, it can just keep going up. And then before you know it, it's going to fall. So you just have to just be patient with that one. But Germany, Italy, Spain, all of these are in this area here. India has been the most, it is just clearly lagging the rest of the market. So most of Europe is in this area right here. Latin American markets right here. Russia, Eastern European markets seem to be right here. Part of the Asian markets right there with India. And then China right in this area right there. So investment-wise, I do believe Europe is going to be outperforming the SPX for the remainder of this year. I think the SPX is still going to be choppy. We'll look at the charts here in a second on the SPX. But I believe we may have an upside of maybe 1 or 2%, which will take us up to around 2150. Downside, I think we get a bigger downside of 3 to 10%. So we've got more downside risk in the market than we do an upside. So that can be a little bit. Yeah, Blake says Monsanto made a bid for another ag company. Is that a sign that corn may be getting stronger? We're going to look at the corn market, and there are a number of ways to play. Thanks to ETFs now, if you can't play the futures market, you can play an ETF that plays these markets. So you just have to wait for a good entry signal on that. So let's take a look at the countries over the past 2 weeks. Well, over the past 2 weeks, a lot of profit taking. You can see here China has pulled back a lot, dramatically relative to the SPX. We're playing FXI to the downside longer term. Russia, also money sucked out of that over the past 2 weeks. Profit taking. Emerging markets, Latin American markets are pulling back just over the past couple of weeks. There's really nothing in the leading sector right now. So the SPX is outperforming. You can see Europe is right here. You can see how they're moving here. Money's come out of Europe. Germany, probably one of the strongest in Europe, sitting right there. But they're starting to move back up. So I feel confident that over the next 30 days or so, you're going to see some improving in the European markets, probably in this area here. And by the way, from an investment standpoint, when stocks are in the improving sector, this is where you kind of want to find your ideal investment right here in this sector. Not necessarily when they're way up here. When they're way up here, a lot of profits have been made, and you would just be a rat brain trader selling it to the people looking to cash out for profits, and then in about a month later, you'll see it come back down into an area like this, okay? Where you want to try and be is kind of like chasing the pigeon or shooting the clay pigeon. You want to be over here so it carries you into the leading sector. That's how I have found works the best. And for those that like higher risk trades where a bounce is when they're down in this area down here. If you guys remember, RSX, Russia, was down in this area for a month or so before it just shot all the way up to the top part up there. Okay, so and you'll see this happen quite often if you follow these kind of charts. They're really good for finding some interesting investments. Transportation sector, past 2 weeks. Okay, you remember I showed you the transportation is kind of bouncing off lows. You can see here JetBlue, Delta Airlines, Alaskan Airlines, from the air sector has done very well. Trucking, Ryder, UPS, fairly well. Rail, CSX, really been just a rocket ship up. By the way, I picked up some puts in CSX. They're way up here. I don't think there's going to be a lot of new longs committed or possibly selling calls, credit spreads above CSX. I think it's going to come down some. All right, because generally in watching sector rotation, when what you find, guys, and this is where retail rat brain traders get into a lot of trouble. Big money is not moving, $100,000 at a clip. They're moving millions, sometimes tens of millions, sometimes hundreds of millions, and they're reallocating all the time. Every week they go through allocation models. And what they're doing is they're benchmarking one sector to another. And think about it. Put yourself in their shoes. If you got $100 million to allocate, where are you going to allocate it to, especially if you've got money already allocated to one of the top performing sectors? You may want to take some profits and reallocate some to sectors that look like they're starting to improve. So just because the sector's top performing, they may take some money out. They're going to leave some money in, but they're going to take some money out and reallocate to another sector. What we want to do as the small retail trader is try and follow some of that allocation. So when you get sectors up in this area here, you're going to see some hedge funds, some mutual funds that may not have allocated to that sector. They may say, well, it's already rich. The valuations are there. So we're going to try some of these others. We're going to look for value-oriented stocks, maybe with some combined with some growth-oriented stocks. So you're going to see that money tends to get allocated that way. But you can see in this transportation sector where this money is gone right now. So I would come in here. You can see Southwest Airlines, Union Pacific, a rail company here, United Airlines, NSC, rail, KSU, rail. You can see these. KEX is a maritime index here, JB Hunt, rail. But airlines are coming out with stronger earnings here. But if oil starts to pull back, which I believe it will, you're going to see the transportation get a little bit stronger here, okay? So we can see here over the past 2 weeks, transportation is really, come on, I need to see follow-through in these guys to get more confident in the transportation. Industrials. I've also included CSX and industrials. You can see it's just done very well. UPS, Caterpillar, money's kind of coming out. GE, after that big run up when they're going to divest some of their company and do a big, huge stock buyback, you can see it's just money's just being taken out. That's profit taking. Union Pacific, Federal Express. Generally, Federal Express and UPS kind of go close together. Sometimes one leads, sometimes another leads. I would say FedEx may probably catch up with UPS a little bit. 3M, Honeywell, Boeing, they're not doing very well. But these stocks have always been in the thick of things, so I would expect a little bit of a bounce in those guys. I do like rail, and I do like some of the shippers, but we got to watch it very closely because the one thing that kind of shows the weakness in the market is transportation right now. Energy. Well, remember what I told you with energy. Everybody was doing really good until about a week or so ago. Earnings are coming out, and they're all being punished. Almost all the ones that make up the energy sector, if you'll notice, they all were in the leading sector, and then they've just kind of all in mass moving here. What's going to probably happen is they're going to continue to move over here in this area here. And then eventually, they're going to start moving back up again. Valero is one. Phillips 66 is one that's kind of outside the norm. Exxon and Chevron they're kind of very big. They're very close to performing at par with the SPX. But we have seen weakness in the energy market over the past couple of weeks. Let's see. Denny asked, for a 2-week chart, do the rig charts update most recent 10 days or at the end? Well, what happens is, and I'll show you how this works. It's really, what's cool about this chart, it updates every time at the end of the day. In this case, I say 2 weeks, but it's actually 10 days. Each one of these circles represents a point in time, okay? And we'll use this one as an example, Apache, okay? So when I run it, that's where it is right now. Or not Apache, APA rig, or this is where the stock is right now. And each day that I run it, and it just continues to move. So the next day, if it moves here, it'll print APA here, and then it'll drop that one right there. So the tail moves down again. So it creates this tail. Now I chose 10. I could have just chose 1, and then it would only show a dot. It would show, you know, something like this, PSX, right? It would just show 1. If I chose 2, then it would show a tail and a circle like that. If I chose 3, it would show this. So I like to choose 10, which is a 2-week period, and it tends to show you where it's coming from. I like to know where it is now and where it's come from. This way I can see over time, just like a chart, right? I mean, if you're looking at a daily chart, you can see, you know, going back maybe a year, where has it come from, rather than just where is it right now. So that's what's so instructive about this chart. You can see where it's come from and where it's going, all in relation to the SPX. One other point I want to make on this chart that's really important, there's a lot more, but I'm not going to go into a lot of detail. The SPX, right, may be going down like this, right? So the SPX may be down, let's say 5%, a big move down. SPX moved down. And let's say you got IBM, and let's say it moved down, right, but only 2%. All right, so it's down also, but it's down 2%. Well, it's going to be up in the leading sector. So you would see IBM up here, and you would say, wait a minute, why is IBM leading? It fell 2%. But again, relative to the SPX, its performance is much better. When we look at sector rotation, and this is all because of how big money managers are paid. They're paid not based on how you would think it would be, but it's not, how well they perform relative to the zero line. You know, are you making money or are you not making money? That's not how they're paid. They're paid relative performance of the SPX. So if the SPX falls 5% and their portfolio only falls 2%, well, relative, they're 3% better, so they get awarded all these nice bonuses. You being the poor dumb schmuck that's holding that investment, you're like, wait a minute, I'm losing money. Yet these guys are making bonuses. So we don't care. At the end of the day, we do not care. All we care about, where is money going? And if we can chase where money is going, in the longer run, we're going to do better than the guy that's not chasing where money is going, right? We're agnostic. And if you try and read the papers and the headlines, you're already behind. The markets are a forward discounting mechanism. Discretionary, Netflix, you know, it was leading, and then it just kind of is falling out of bed. But we can see Amazon, Yum, Starbucks, Priceline, doing very well. Ford moving up, but you can see a lot of the discretionary underperforming. Some of the real estate, Lennar, Pulte Homes, some of the retail, Coach, Wynn, BBY, Coors, another retailer. Ford is moving up just a little bit. So you can see in the discretionary, it's really kind of split. I don't get they're all like this. So you could draw a line and say discretionary and just ignore this outlier, Netflix. We've got some outperforming, some underperforming the SPX. So it really gives us kind of a mixed signal. This is what's holding them up, right? Now these are the bigger holdings of the discretionary side right now. And you can see that they're holding them up. Starbucks, Priceline, these kind of guys. All right. But then we've got it also being dragged here. So this is a hard one to read because these guys could go down. These guys could stay here, and then you'll see all of discretionary tanking. All right. And we want to watch this very closely week to week. If we look at financials has been improving some. Prudential, Wells Fargo, KeyBank, Metropolitan, BAC, Zion, Citi. These are all good ones in the financial sector. Not that they've made money over the past 2 weeks, but they're outperforming the SPX. Goldman Sachs, JP Morgan, AIG, underperforming the SPX. Financials, if interest rates stay up and start to go up, I think Wells Fargo, Prudential, some of the insurance companies. Another good insurance play is Aetna, AET. I don't have it on here, but it's doing very well as well. Technology. Well, lo and behold, who do you think is leading technology? Microsoft. Wow. That is a big surprise. In fact, a lot of big money has been going into Microsoft. You can see it each day, just, running away from the herd. But technology as a group has done good. IBM, Micron, eBay, CRM, Visa, Broadcom, Qualcomm. You can see over the past 2 weeks, there is a huge momentum in technology. Okay, the only ones, the rear, Yahoo, obviously doing very poorly. Okay, but Microsoft. So to me, Microsoft seems to be a good bet. It's also at all-time highs, and I think it's going to get stronger over the coming summer months. Materials. FCX, Freeport, McMoran, copper. Remember I showed you copper in the commodity market is starting to get stronger. JJC, Freeport, Cliff, Dow, DuPont. These are doing fairly well. Stay away. And I like, even though Sherwin-Williams had a bad earnings right there, Sherwin-Williams generally doesn't get too far out of that circle right there, meaning it's either leading or lagging the SPX, but it's pretty darn close. Sherwin-Williams is all about paint. We're coming into the summertime now, so home repair, painting. I think Sherman is going to slowly get back up here, so I do like Sherman. Moving on here, if we get healthcare, remember what I said about healthcare. Money is coming out of it. Merck is really strong, but otherwise money's coming out. AbbVie, one of the stronger plays in healthcare coming out. Biotech, you can see money coming out. BIIB down at the bottom down here. Celgene, Gilead moving down a little bit. Amgen, some of the prior strong United Healthcare, J&J, they're all in the lagging sector. Now, even though healthcare is leading the markets year to date, this just tells me money is coming out protecting profits. I think money's a little bit afraid as we go into the summer season here. You've heard the saying, sell in May and go away. Well, we'll look at the charts here in a second and take a look at that. Consumer staples. Again, this is not bad for consumer staples. If they were all leading, this would tell me risk is really coming out of the market. So consumer staples, when their risk is coming out of the market, tends to outperform. But the one thing that concerns me here, you can see a lot of these guys here are moving up into this direction here. That would tend to suggest that money is still coming out of the market and seeking safety. I've loved Monster Beverage in the staples area. That's one of the better ones out there. So that's kind of where we're sitting right now on the consumer staples. Yeah, Blake, that's right. Let's see here. Let me just let's get this right here. Utilities, all over the board. But the one thing about the utilities, you saw year to date, it really is performing very poorly. We've got a lot of utilities starting to separate into winners and looters. I've been watching TV too much. Winners and losers in the utility market. The fact that we're getting a lot of them up here tells me that that money is again seeking a little bit of safety in the market. Ideally, I'd like to see all the utilities down here. But we've got kind of, again, a bifurcated market where we got some really outperforming, some poor. If you go into utilities just to kind of rest your money a little bit, these would be some of the winning ones that I would look at right here, okay? Or just XLU. Let's see here. Okay, let's take a look at the oil market real quick. For those of you that haven't seen my futures education series, I'd go check it out. It's on our website under the library or education center. But looking here, I saw this on Bloomberg, and I thought it was a really interesting chart. This was the middle of this week, and this was 2 months ago. So you can see 2 months ago, oil out in time was priced right around $70 a barrel, way out in time, okay? Meaning the futures market a year out or a couple of years out, the futures was pricing oil here. Now today, the same futures market is pricing oil lower, all right? So what can we make of this? Well, for those of you that understand how the futures market works, oil is in this huge contango. That means that if I were to draw a line and say May, June, July, August, September, and I were to price oil on a graph, and we go look at each one of these futures contract months, you can see that the current price is here and September is here. So the futures market has priced in a higher price for the September oil futures contract. What this did is show you that yes, but then over time the September futures contract is coming in, which it should do, but it's coming in at a faster rate. So the futures market is saying that, well, a month or so ago we believed oil was going to rise faster, but now going forward in time we think we're not going to be pricing in as strong of a contango market. If you've got a price where contango looks like this over time, and then it shifts to this over time, and then it shifts to this over time, well, then the futures market is not pricing in a large increase in oil over time. It's moving down. So I take this to read that we are getting, or the futures market is saying, you know, we're going to put a lid on oil going out over a year. Okay, that's one point I want to make about the oil market. The other point I want to make, because I saw this again on Bloomberg, dealing with the oil market, is the short hedges in the oil market. Now, this is the professional trader. It's not the rat brain trader. These are hedgers. You can see right now the hedgers they're at all-time highs in the oil futures market, okay? Which means that, and this was taken about the middle of this last week or so, about a week or so ago, the shorts in the oil futures market are going up and up and up and up, okay? They're hedging because they believe a top may be coming in place. So when we get this kind of view, that does also put downward pressure on the oil futures market, okay? That's point number 2. Point number 3, I'm sure all of you guys know that the inventory levels, here's the inventory of oil right here. And this was through the middle of April right here, okay? And it goes back through 1985 on this chart. I really like this chart because it kind of shows the natural range of oil inventory levels, oil stocks. When oil inventory levels go low, oil prices tend to rise a lot. When inventory levels go up, oil tends to go down a lot. And you can see this huge spike in oil inventory levels. So what a lot of big companies are doing, and I say big companies, I mean multi-billion-dollar companies, they'll buy ships, they'll put oil on those ships, and they'll park them. They won't touch them. The cost, because of the contango in the market, they'll let those ships sit there, and then they will go out in time a year and sell that oil. And they'll hedge it, they'll sell it, they'll short it. So part of the reason why shorts are up is you can say, look, you mean I can produce oil, pull my product out, pick it, plant it, grow it, whatever, and now I'm sitting on it, and it's only worth $1 now, but I can sell it now for a year delivery for $2. So now I got $1 profit, and out of my $1 profit, I'm going to subtract my storage cost, in this case, the cost of a container ship, for a year, and I'm still guaranteed a profit because the cost of holding it for a year is less than the profit of selling it in the future. So what happens? You get all these shorts going up, which tends then to drive the contango tighter and drive the market down. All right, so it's all interrelated. All right, it just doesn't happen by accident. We got high inventory levels. I will show you in a minute how we're playing this in the oil market. It's really interesting. It makes for a fast trade for those of you that really, you know, have that rat brain part of you that really wants some action. One other thing with the oil market that I found very interesting. In the United States, we are now we're one of the leading, from a lagging to a leading oil developer, oil and energy. These are major regions in the United States, mostly in the Midwest, North, generally, of shale regions, where we are now, with the new technology, been able to extract. These are uncompleted wells. As you guys know, it's called the frac log, inventory waiting. These are wells that are uncompleted but are waiting to be completed. The big oil companies as well as frackers have just said, okay, we're 30% of the way through, 40% of the way through, 60% of the way through. We're just going to let that well sit there. We own the land. We're not going to produce. We're going to let it sit until oil gets a little bit more expensive. You can see huge backlogs waiting. Now, what happens the higher oil goes, up to like maybe about $65 a barrel, you're going to see a lot of this inventory start to go down, and they're going to complete these wells. Why? New technology today, unlike 10 or 15 years ago, you can get a well from zero to completed within 90 days, and it's pumping oil, or it's fracking, and it's converting oil. So now the time from just an open land to I've got an oil pumping and I got black stuff coming out of the ground is very, very fast. So what's going to happen is a lot of them are waiting. They're still producing. And as you saw, inventory levels are up, but that's going to start to drop off. And once oil gets a little bit higher, they're going to release a lot of this backlog and start producing more, which is going to put a cap on just how high oil will go. That's going to put a forced cap on oil. So it's called I'd call it a frac put, like the Bernanke put or the Yellen put in the SPX. So it's going to, I don't believe oil is going to go up that much more. Okay, so I wanted to show you these charts and just set the way. Let's go look at the markets right now. Let me just freeze my screen for just 1 second, and let me just come in here. And we'll go look at the charts, and let me just back it out. We're going to start with the SPX, and then we're going to go into oil. And we'll focus on oil today. For our members, I'll probably tomorrow night or Sunday night, we'll talk a little bit more about corn and some of the opportunities I see coming up there, or soybeans, and why soybeans maybe even be better. But let me just show you some things in the market right now for everybody on the line here, or on the webinar. So let me get my screen back up. and I'll explain it to you. Okay, what you see right here on this screen is a monthly chart of the SPX, okay? It's a monthly chart. Let me just zoom in a little bit here so you can see this. First of all, in the SPX, you can see this was the dot-com bubble right here. This was 2007 right there before we gave it all up. We took out that low right there back in 2002 at the end of the dot-com bubble, right there with the 2007-2008 crash. And then we've just been hell-bent straight up. I've got a channel in there. We'll look at that in just 1 minute. I've drawn a Fibonacci extension off the lows and the prior high. All right, so this Fibonacci extension on this chart goes back to 2007. These are the key pivot points. When you go to a monthly chart, there's just a couple of key pivot points on this chart that take us back, you know, a couple of decades, really, just about. So let's zoom in a little bit on this monthly chart, and I'll show you what we're looking at right now. All right, so just so that I've set the stage here on this chart, you can see I put a Fibonacci extension in. I'll explain these colors in a minute. The key Fibonacci extension that's probably one of the strongest, there are a couple of them. One is this red line here, which is a 50% extension, right, off the prior pivot high and the prior pivot low from 2007 to March of 2009, and the 61.8% extension, again, off the same pivot points. We are now sandwiched in between these two, with the 61.8 in purple being a major, major resistance point sitting at 21.39. All right, and remember I said the upside risk is roughly up to 21.50, and then taking us down, and I'll show you that downward in a minute, okay? So now that you understand the purple line and the red line is the 50%, the 61.8, let's zoom in a little bit. But before I do that, I want to show you something else that's a little bit intriguing. You guys have heard the saying, sell in May and go away? Well, guess what? This is May 1st. And let's just zoom in a little bit, and I want to show you something. Again, we're on a monthly chart. If we look at this time frame right here, that is the month of May, right there in 2010, right there. You can see, again, a monthly chart. We started here, and we ended here, right in July. So May, June, July. That was a 3-month pullback. We're not used to seeing 3 months of pullbacks right now, are we? To us, a major pullback lasts 1 or 2 weeks because the markets have just been flooded with money and money coming in from Japan and Europe. But that's a 3-month pullback. That started in May. All right? Let's look at this one right here. Again, that one started in May of 2011, and this one started at this point right there and ended at this point right there. So that was 1, 2, 3, 4, 5. That was 6 months. You guys, surely 6 months would have half you guys in some kind of schizoid fritz because you wouldn't know what to do with 6 months of steadily moving down. But that was a 6-month pullback. Again, started in May. Sell in May and go away. If we look at this one right here, going back to 2012, what month is that? That's May. This one was only 3 months, all right? 3 months. Started in May here, went down like that, okay? We're looking at really those that lasted more than 1 bar or 1 month, okay? This, again, 3 months. Now, if we come back and we look here, this was May. We went up high, we went down low, and then we came back down, and from May, right here, we were almost, we didn't go anywhere. We went down, we went up, and that was 4 months, and we were flat through the summer months here. We did go down in May and June. That was 2 months, right? Right there. So here we go in 11, 2012, 2013, 2014. All right, 3632 as far as the number of months. Now we're coming into 2015. Does this mean that's what's going to happen in 2015? Of course not. But I wanted to just point that out, that it seems like because it's true, everybody trades like it's true. And if everybody trades like it's true, volume will dry up. Yesterday was a strong up day, but it was very weak volume yesterday. Thursday was a very strong day down, and there was strong volume down, which told me there was some distribution on the last day of April going into May. Okay, now we look at this monthly chart. Again, each bar represents 1 month. You can see we've been in this very tight pattern really since a few years going up, and just a few times we've been below it. This big time here was October of last year. That was that big drawdown, but we finished at the top of the bar, right? So it was just a spike down and a spike up. Outside of that, we've stayed inside this channel. We will break this channel again. You guys know we will break this channel again. Question is, when? Well, the odds favor this summer rather than not. Again, we want to play probabilities. You can also see how close we are to that 161 extension off the prior pivots. Okay? Now, let's take it down to a daily and really zoom in. Here we are on the daily right here. You can let's get it back up here. You can see here the purple line right here is the 161, right around 2138, 2140, somewhere in this area right there. That is huge, huge resistance for us. Okay? You can see this blue line right here, which is where the SPX opened for the year. Okay? You can see the red line is the 50 EMA. Okay? We made new highs in the SPX. As soon as we made new highs, probably just because we could, I will move this up right here. We made a new high back on the 27th, and then we've been kind of going down ever since, 21.2592. Very close, 21.2592, very close to the 161 extension here. So I believe that the higher we go, we're going to set ourselves up again. There's going to be a lot of weakness. Now, how have we been trading this? I've been trading this with credit spreads north of SPX. That's what I've been doing. It's been very well. And when we picked up volatility the other day, I put on some more credit spreads because the price and the premium of the options got a little bit more rich. We wanted to take advantage of that. So you can see where the SPX is. All right. If we look at the E-minis, the futures, you can see right here, very similar. This is where we're sitting right here. Blue line represents the opening price of the year. You can see the zones, the support and resistance zones where we're sitting right here. You can see this longer term is not as well developed as I would like. Bearish divergence from that high and that higher high here. Again, that would suggest more weakness in play is what it would suggest, something like that. So I think it's, and earnings, by the way, are about 3/4 of the way through. I don't think earnings are going to allow us to come up and push the market up into this uncharted territory here. We need to see better results out of government economic data, and basically all the economic data I've seen lately has been fairly weak. And when it's weak and the markets go up, that means bad news is good news, and when we hear bad news is good news, what does that mean? That means the friggin' feds are going to keep interest rates lower, longer, which tends to create these asset bubbles, which drives the price higher. And the higher we go, the more of a bubble that's going to create until the Feds say, hey, we're going to raise the rates. Now, everybody knows that we're going to raise the rates. We just don't know when. The markets right now are calling about a 30% chance in the month of June, and then maybe a 70% chance in the month of September. And the markets have said June, September, right? And you got to look at this and say June, because that's a quarter, new quarter begins. September, a new quarter begin, end. Because Janet Yellen does her press conferences every quarter end, and the thinking being they will not raise their rates until she does her press conference. Well, the Feds just threw a monkey wrench in that too, where they said now Yellen may do webinar, internet-based press releases every month. So now that opens up the months between when they can raise their rates. So we don't need to play that guessing game. You can't. You drive yourself crazy. But that does mean that at any time beyond June that we can see a rate increase on the next FOMC meeting. We also got the issues with Europe and so forth. So it's with the Greeks and just there's a lot of things out there that can set it down. So the contagion effect says if the Greeks exit, then that'll be a leading entry for other countries to talk about the same. So where can we go to the downside? Well, right now the markets are sitting right at about, let's call it 2101. The E-minis sitting right at this point right here. Okay, that's where the market is right now at that price there. And if we say the markets drop about 7.5%, that's roughly about 157 E-mini handles, right? And if we subtract it from 2101, that puts us down around 1943, right in this area, right here at these key pivots, roughly, give or take a few points. So this to me is the risk of a downside move to this point right there. The upside move may be up in that area there if I had to draw it on the chart, right around that 61% extension. So if we said this is the potential range over the summer months right here, right? And we're sitting at this point right here, would you want to go all in when you see that, yeah, we got a little bit more upside, but we got a lot more risk to the downside? Or would you want to play all downside? We don't do both. Right now, we're playing both ways. We're doing a little bit of upside. I've got some longs in here, but I'm also playing the downside, and I'm playing a very wide split in the SPX with short puts and short calls above. In fact, we've been doing this since January of this year. All right, and it's worked out very well. We've been doing the same thing in the oil market as well. So that's kind of, and by the way, this is how a lot of, this is how I see the market. And I don't really care what the headlines say or what the CNBC TV talking heads say. I just play where the price action's taking me and what the charts are showing. And you can see on this daily chart, if we just kind of condense it a little bit, how this trend line goes back a pretty long ways. And we've been very tight in this trend line back to 2011. We only went out of it really big time once. That was last October. Okay, that was October of 2014. And then since this move right there, it did a lot of damage. That bottom point right there, I think, is going to be challenged again. Possibly challenged again, but we got to get through that area right there. The low for 2015 is 1970.25. So I believe if we get some downside action, we can test the low for 2015 this summer. Excuse me. If that breaks and then the fear really takes hold, then we can challenge the October 14 lows right there. I don't see much lower than that. Okay, I really don't. But notice as we've been moving up our upward vector, starting right at, and if I were to draw the line that separates 2014 from 2015, right there, This whole area here is 2015. You can see going into it, we started having trouble. And we've just been we've kind of lost focus of this upward movement that we've been having. All of a sudden, our trade vector has been relatively flat. We've been running steady for the past 2 or 3 years and a nice upward vector, and now we've been flat. This is also a sign of a topping action because topping actions don't happen overnight. They happen over a period of time, and then they suck people in by doing these spikes up, making new all-time highs, and then they just work their way down. So we're setting ourselves up, like I showed on that monthly chart, for having a really suck-ass summer. Doesn't mean that's what's going to happen, and I can guarantee if the prices keep going up, I'm going to play them long, but I'm ready for that move to the downside, or at least flat, steady. And you can see on this daily chart, as I've kind of condensed the chart a little bit, even on the daily, you can see higher highs very clearly, right? Higher highs, but you can see that bearish divergence setting up there very clearly on the chart. Also, I could probably draw this line in like that, draw that line in like that, and we got this rising wedge, which suggests also a break to the downside. Okay, so that's a little bit about the markets and the indexes. A couple of other things, and we're going to go take a look at the oil market real quick. If we look at the Russell, the Russell was leading the way. Now look at it. The Russell has come unglued. Money starting in April came out of the Russell. Look at this right here. This is the Russell futures. That is the opening price of the RUT futures. We almost hit that this past week right here. Here's the RUT right here. Very poor action, right? We're far away from the opening price of the SPX right now. Very weak in the Russell. Money has come out of the Russell. If we look at the NASDAQ futures, it's the strongest player right here. We're above the 50 EMA in the NASDAQ futures. We're nowhere near the opening price. Showing some weakness, the 50 EMA held. And if we look at the E-mini futures, again, we're above the 50 EMA. It looks very similar to the NASDAQ, okay? But on a relative basis, the E-mini futures are closer to the opening price of this blue line for the year. So that's kind of where we're sitting there. Let's look at bond market real quick. I'm just going to cycle through these. Look at what the bond market has done. It has come unglued. Now, I've been short bonds. I've been talking to our members about this, or short TLT or long TBT. TBT is the inverse. It follows interest rates. Bonds have come unglued. My chart seems to want to say that bonds is going to give us a bounce to the upside of this channel. I wouldn't be surprised to see that. We get a bounce, I'm going to be happy because I'm going to use that as another entry point to take more shorts. I think bonds are going to come down to this area right there. All right, that's where I think bonds are going to end up. But as you know, things don't go like that. Things go down, up, counter trend move, down like that. These counter trend moves, we want to be sellers, not buyers. So we're sellers on any rally in the bond market. Same thing if you say, hey, I can't trade bonds, I trade TLT. So we look at TLT, same thing, right? Here's TLT. TLT took out the opening price of 2015. They're 126.29. TLT is now net negative for the year. Doesn't surprise me. We want to be short TLT. 122.56 is the low for 2015 for TLT. I think we're sitting right on the 200 EMA. I would expect a little bit of a bounce here, and then we're going to come on down and just keep right on trucking. TBT, just the opposite. TBT follows interest rates. We're going to just keep right on trucking with TBT to the upside. A little bit of a counter trend move down, and we're going to keep trucking up. We're not going to go into currencies or metals. I want to spend a little bit of time in the oil market. Here's oil. We've had this nice move up here in the oil market. It's an Elliott Wave 3, which suggests there's further room to run. I believe we're going to run out of energy up here like I showed you. The 200 EMA is sitting right at about 67.56, but it's got a downward vector. It's probably going to run down and then probably get steady right in this area here, right around 65 a barrel. I said if we break, we were in this range for a long time. I said if we break north of this range, we'll see $60 a barrel before we see 40 a barrel. And I said if we break down below, we'll see 40 a barrel before we see 60. Well, because we broke above it, I'm now sticking to the 60, although we had a little bit of a kind of a steady state here. Just like the SPX, I've been selling calls and selling puts below and above the market in a very wide range in the oil futures market. It's been a good trade for quite some time. In fact, I've been doing this for the entire year. All right. There's a little bit of risk in the trade because oil tends to spring up, not down. Okay, oil spikes up. In fact, generally when oil goes up, unlike equity markets, volatility goes up, not down. When oil is steady state down, volatility comes down. Although in this case here, because oil was such in a hard down move and just getting cratered, volatility went up, which we love in these short strangled trades here in the oil futures market. USO would be another way to play it. Now this up move right here that you're seeing on the chart, it's like Charles Madden drawing a football chart, isn't it, guys? In this up move here, we played XLE, okay? We got out of XLE for profits, and now, but I have been trading oil the entire year. Now, let me show you one of the ways. One of the ways I've been trading it, as I said, is I've been shorting calls and shorting puts above the market with the short calls, below the market. So I've got this wide range, and as long as it trades inside this box, then I'm a happy camper. I think oil is going to stay inside this box for the reasons I suggested earlier. If it moves up, more wells are going to come online. Inventory levels are going to stay high. Okay? If oil starts going down, more wells go back offline. Inventory levels start to do steady state, and we get this chop again. And if it gets way down here with my short puts, I'm going to wait to be assigned, and I'll own oil all day long at anywhere from $33 to $35 a barrel. I'll buy an oil futures contract at that price. Okay, so that's kind of that trade there. If you don't have the margin or you don't like being short, naked shorts, then you can add a long call outside the price there just to hedge to cover it. But it is a good, solid trade to do. I highly recommend, if you can't trade futures, you set your account up to trade futures and options on futures. We got some good videos on that you should take a look at. Now, how have I been trading it? Let's go take a look at oil. All right, this right here is my Thinkorswim platform, and this is the oil market. You can see right here, I've been doing this every week. You can see that big spike up right there. Now, this is a 2-hour chart. We'll zoom in a little bit. This spike up is oil inventories come out on Wednesday, all right? Comes out every Wednesday at 10:30 in the morning, Eastern Standard Time. That is New York City time for a lot of you folks that are international on this morning's call. And I don't know which way the inventories are going to go. And if I were to tell you, hey, the inventory is going to come out and inventory levels are going to increase, you would say, well, then let's short oil. But you'd be wrong. Inventory levels at this at that bar right there came out, and what did inventory do? It went up. And you'd say, well, why the hell did oil prices go up if inventory levels went up? If you were to read the details in that inventory report, yeah, it went up, but it went up at a lesser rate. So a lot of the players are making the assumption that, well, inventory is still rising, but at a reduced velocity. So inventory levels are starting to steady state, break even, and then we'll see the inventory levels fall and oil will go up. That was the logic behind that move. We don't care, right? We do not care what the logic is. All we really want to know at the end of the day is, are we on the right side of the trade?
Well, what we want to do is shift down to about a 3-minute chart, or you can use a 5-minute chart. And you're going to bracket the trade like this. And you're going to see here oil is steady state before the inventory report. Now, this is a 2-hour chart, so that goes back almost a full day into the night because it's 10:30 in the morning. I'll show you what it looks like in a minute on a 5-minute chart. And then what you do is you come above the market and you put a long futures contract. You go below the market, you put a short futures contract. So on the Thinkorswim platform, and I don't know if some of you that you don't use Thinkorswim, you can use another platform. But I've got an oil ladder trade here, and let's say the current market is right here. I'll come up and I will put on the green column here, I'll put a buy order of, and let's say 1 contract or however many you want to do. I'll put a sell order in down here of 1 contract or how many you want to do. And then as soon as the inventory reports come out, oil is either going to shoot up or it's going to shoot down, or it may go down, reverse, and go back up, or it may go up, reverse, and go back down. But it will pick a direction. And once it solidifies that direction, it moves strong for about an hour or 2. And then people take their profits and they get out. They kind of steady states again. We want to make that trade. So what we want to do, and by the way, I've been doing this for about for the past 5 or 6 weeks, only because inventory reports are such a big play right now. Everybody's looking at inventory reports. We play it now because it matters. Maybe in another month or 2 it may not matter. But right now, it matters. Everybody's looking at inventory reports. So we come into the 5-minute chart right there. You can see right there, let's just zoom in on when it happened. Right there. There's the trade right there. So you can see right in this area here, and you want to look at the trade. You can see on a 5-minute chart, it's fairly tight, right? Fairly tight. And then you can see 10:30 right there. And oil is really funny. You can see if you were to look at it at 8:30 in the morning, you can say, okay, it's very tight. And then you can see oil slowly starting to cheat. I don't know if someone has information into the inventory reports or not. I don't really care, and you do not want to play that up move right there. But you want to look at it. And then around 10:15 in the morning, remember the reports come out at 10:30, okay? So about 10:15 in the morning, you want to look at this thing, and let's just zoom in again. Let's open it up a little bit, okay? So now we've got this right here. You can see right at 10:15, here's 10:20, 10:25, and 10:30. So what I will typically do is I'll start looking at it about 10:15, and I will start placing my highs and my lows going back about an hour, because no one is going to go long or short oil in a big enough manner to really move oil a lot before that inventory report. No one's going to do that. Some small shorts or small longs, which will kind of give it a drift like you can see here, okay? And then what you're going to do is, and what I've done that's been very successful for me, is I will then come in, and let's take it down to a 3-minute chart, okay? And let's go back again, and let's look at it again. You can see right here on this 3-minute chart, I'll point it out to you. Here's 10:30. You want to be in the trade right around 10:25. So you can see right in that area right there, right about there. You can say, okay, well, the high right now at 10:25 is right here. You do not want your trade to trigger before 10:30. You do not. So you want to go in above the market, high enough so it doesn't drift into it, and below the market, low enough so it doesn't drift into it. So you've got a contingent order. Let me just draw this in here a little bit differently so you can see it. you want to have a contingent order right here and right here, okay? Now, and then when the inventory reports come out, either your long will hit or your short will hit. If your long hits, you're in the game. As soon as your long hits, you take your short, you move it up to become your stop. You don't even need to take the order out, just move it up. And then generally you'll see it move up very quickly, very fast, have a little bit of a counter trend move. That's normal. Resist the urge to shut down right here, and then give it a little bit of time to move up again. You'll see these counter trend moves where profits are being taken, right? Because people, we're not the only ones doing this, by the way. So profits are being taken. Give it a little bit of room and let it run. It's $1,000 a full 1 point move, okay, or a dollar barrel move. In this case, it triggered at about 57. Call it 57.6, right? 57.6, and you could have taken it up to about 58.8, right, in this particular case. So about a 1.2 move, that's $1,200, literally, per contract. You know, so, and I've got members that are doing 5 and 6 contracts at a clip. So that's about a 7 or an 8K move, okay? So that's what happens when it moves, and you don't know which way it's going to go. It could trigger and go to the downside. Now, that's the good side of it. Let me show you the risk in the trade. There are a couple of things with risk, because with anything in the markets, there is risk, okay? So, again, you bracket the trade, right? So we bracket the trade like this, and we say, okay, we're going to set our buy and our buy order or our short order outside the price. So we're going to go above and we're going to go below. And let's say the market moves up and it triggers. Now you're long here, and then all of a sudden the market moves down here, and then you're triggered out and you're stopped. So the distance between your long and your short is your risk. So generally, call it maybe 2 times out of 5 or 1 time out of 4, you're going to find a move like this. How many times have you seen a big number come out, it moves up, and then a couple of minutes later they go, oops, we got it wrong, we're going back down. And you may get triggered here, and then you may get triggered there. And sometimes it can happen in a blink of an eye. Sometimes it takes a couple of minutes. Okay, that can happen. So that is a risk. The other risk, which is even bigger and could be a little bit worse for you, is one of these kind of risk right here. And this has happened to me before, so I wanted to tell you, you just have to be careful of this particular risk here. And it depends on your trade platform. Your trade platform's got to have its act together. There is the range right there, right? And then you come in and you set a buy order there and you set a sell order there. And let's say that, and this did happen one time, and it's just that the market makers are just going to screw with you. It comes down and it triggers your short. So boom, you're like, okay, good, we're going long. You got a happy face on your, you're happy and you're going, oh good, we're going to ride it down. And then all of a sudden it reverses and moves back up. Literally in seconds. I mean, just seconds. You can't even click the mouse fast enough. And then it blows right through your sell stop, in this case, and keeps going up. And you've got your order here, which is your buy stop because it's long, and it doesn't trigger, and you're like, what, WTF, what the fuck? It's way up here now, and this thing is sitting here. Sometimes, if your platform is not good, it moves so fast, it'll move through your order. A lot of platforms, not a lot, a few will screw up on you. And now you're sitting way up here, and instead of being down, let's say, $300 or $400, you're down, $1,200 per contract, all right? And if you did 5 of them, you're down 5K. So I always suggest to people that have a larger portfolio, when they try this, go in with one and try it and set your buy and sell orders. The wider, the better, but the wider, the less profits you will make, okay? Because it's got to travel the range. But right now, over the past, I would say 6 or 7 weeks inventory reports that come out on Wednesday. And by the way, this works the same for gasoline futures, and it works the same for natural gas futures. Natural gas futures comes out on Thursday. The inventory levels come out on Thursday at 10:30 Eastern Standard Time. Okay, so this is just a fun way for a lot of you traders out there that are looking for a fast action on the trade. Okay, I have not done this trade using UNG for natural gas or USO for oil. You could do that in the equity market and put a buy order and a sell order and just try it from a stock perspective, right? You could try that. I like the futures market because it could be a quick, $5,000, $6,000, $7,000 add to your account, and you don't really care which way it goes. You just want it to go, okay? So anyway, guys, I wanted to share with you some of the things that I see in the oil market and how I've been trading it. It's been very successful for me and for a lot of our members for the year. Okay, and gasoline, you can see gasoline is also strong. We're over, $2 a gallon for gas right now, but we're setting up for a little bit of weakness in gasoline, so watch that, even though we're in the seasonal strong time of gasoline. All right, everybody, I hope you enjoyed our monthly recap session. If you are not a member, I highly encourage you to come check out our site. We got a number of different membership options, or I've got a number of educational videos out there. Be on the lookout for the first Saturday of every month. I'll give you another, we'll have another session then. For our members, I will see you tomorrow night in our weekly market watch. Take care, everybody. Have a great weekend. Enjoy the spring and early summer months for those of you in our northern hemisphere. For those of you in Australia and Brazil and other places, you're going to be ending your summer and you're going to be going into the winter time. So enjoy the winter. Take care, everybody. I'll see you guys later. Ciao.